Welcome to the Canadian Income Tax Basics course. I'll be your instructor, Danish Ghazi. I'm a CPA CA with over 14 years of experience in corporate finance as well as working in public accounting. I've worked for multi-billion-dollar corporations, for tech startups, for private enterprise, making sure the revenue, costs, taxes are all heading in the right direction and where they should be. The goal for this course is really to give you an overview of how the Canadian income tax system works. How are taxes calculated? Why do you pay so much tax? How can you take advantage of a tax system to make sure you are taking advantage of all the tax credits, all the tax deductions, and all the tax benefits that are available to you that maybe you don't know of? And how do you file taxes? What are taxes due? We're going to go through all those elements in this course and more. You can also find me on YouTube where I make videos on personal finance, taxes, the stock market, and everything in general related to making money in general and how you can take advantage of the system. So feel free to look me up there if you are interested as well. Let's go through what this tax course will cover and what are the 5 modules we'll be taking a look at. So the first module we're going to take a look at is called What is Income Tax? And the purpose of this course is to give you, the purpose of this module is to give you an understanding of how tax is calculated. Why do we even pay tax? Where did the tax system even come from? The important criteria that's used to calculate the amount of tax deductions, the benefits you can potentially receive. The second module is important tax definitions and tax terms that you need to know. You may have heard of a notice of assessment, the CRA, an audit, a TD1 form. These are all terms that are thrown around and maybe you don't know what they represent, or maybe you have an idea, but we're going to go through those and what they mean for you. The third module we're going to talk about is what are some of the common expenses that are tax deductible? Because no one wants to pay more taxes than they should. So how can you take advantage of these deductions that are available to you? And how do you even put them on your tax return? The fourth module is specifically designed for students. You're paying for housing, you're paying for tuition, you're paying to, if you're a foreign student, you've come to Canada and you are paying international fees. What can you do? And first of all, do you even have to file taxes as a student? So we're going to go through all of that in this module. The last module is called Common Tax Mistakes. And this is something I see way too often. Every year, there are Canadians, international students, temporary foreign workers, everyone who has to pay taxes, they're making these common mistakes. And that means they're paying thousands of dollars in more taxes than they should. I'm pretty sure that money is better off in your pockets. So we'll go through some of the common pitfalls and how you can avoid them. With that said, let's jump right into Module 1. The first module we're going to take a look at is called What is Income Tax? I mean, you pay taxes, you probably see it in your pay stub, there's various deductions, but what is really income tax all about? And why do we even pay tax in the first place? So let's go through all that. Now, in order to understand what is income tax, we're going to break this down into 5 topics. The first is Canada's income tax history and system. How did we even get here in the first place? The second, we're going to talk about income tax rates and brackets. Meaning if you make $100,000, if you make $50,000, if you live in Alberta, Ontario, how does that impact how much taxes you end up paying? The third lesson we're going to talk about is income tax filing. How do you even file income taxes? Do you have to file income taxes? Is there any way to not file tax if you don't make any money? So we're going to go through that in lesson 3. The fourth lesson is the income tax benefits. What benefits are you eligible for? What tax credits can you take advantage of? How can you make sure you are paying the fair and your right share of taxes? And the fifth one is Canada's income tax reduction strategies. Is there anything you can do to pay less tax or optimize taxes that you may have to pay based on income levels? So we're going to go through all those tax strategies in this 5th lesson. So let's go through lesson number 1, Canada's income tax history. So here's a fun fact. Income tax hasn't always been around. It's really only been around for just over 100 years or so, and it was actually implemented during World War I to help Canada fund efforts for the wartime. So what that really means is that Canada's income tax was actually first imposed at the federal level back in September 20th in 1917, and this was only supposed to be a temporary measure to help finance Canada's involvement during World War I. And 100 years later, we're still paying taxes, so it wasn't really all that temporary, now was it? And after that, what that really meant was that if you are a young male and you made anywhere between $2,000 and less than $6,000, your tax rate was 4%. Now, if you made over $6,000, which was, again, you're thinking about 100 years ago, so this was a lot of money, especially during a war at that time. If you made over $6,000, you're paying roughly 25% taxes. It's really very simple, temporary, and 100 years later, it has definitely changed and taxes are still around and way more complicated. And after the implementation of income tax in World War I, it stuck around for World War II, and it evolved a little bit. And what happened was that this was the first time where the Canadian federal government really took command and pooled all the various tax revenues under one central authority, and that was the Canadian government. And in 1941, the provinces agreed to give up their share of taxes and just make sure that the federal Canadian government can essentially pool everything together for World War II. And then after the war in 1948, the Income Tax Act was implemented, replacing the Income War Tax Act, which was a temporary measure. So this is the act that we have in place. It is called the Income Tax Act. And it was about 20 pages at the time, and today it is over 400 pages. And since then, tax has only become more and more complicated. So for example, in 1987, there were a number of tax brackets, and they were initially 9, and they were reduced to 3 in 1987. And then following that, tax rates were also indexed to inflation at over 3%, which resulted in no changes really to tax brackets between 1991 and 1999. And at the turn of the century, remember when during World War II, the provinces gave up taxes so they can just make sure it's all under the federal government? Well, all that changed in 2000, where the provinces took that away from the federal government, where they could tax corporate and income tax rates directed at individuals at the provincial level. And since then, the income tax brackets have increased. First, there were 9, they were cut down to 3, and from 3 to 4 and to 5 tax brackets. And we'll go through those tax brackets in the next lesson. And really to summarize that, tax was a temporary measure that came during World War I to help finance the World War effort for Canada's involvement. And since then, it's just got a lot more complicated. We have various tax strategies, there's various tax deductions, and that's the point of this course, is to go through all that. So with that said, let's take a look at income tax brackets. Lesson number 2, income tax rates and brackets. Canada, as I mentioned in lesson number 1, has both federal and provincial taxes, and the tax rates will vary based on which province you live in. Although the federal rate won't change based on your province, but the provincial rate will differ from Ontario to Alberta to BC to Nova Scotia, etc. And how much taxes you pay will be based on how much income you make. Essentially, the more you make, the more you pay in taxes. And the tax brackets are adjusted annually to account for inflation, meaning the numbers in each bracket will change slightly every year. So it is important to make sure you know which bracket you fall under, because it will change from year to year. And the tax rate for each bracket will only apply to the portion of your taxable income that falls within that bracket. What that means is this is how we call a progressive tax system or a marginal tax system. I'm going to give you an example of how all that really works. So for this example, let's take a look at what happens if you live in Ontario and you make $100,000 in annual salary. So if we take a look at this tax calculator, I've put in $100,000 of employment income. And as you can see, if you make $100,000 in Ontario, the total amount of tax you will pay is $26,347. That breaks down to $14,362 of federal tax, $7,228 of provincial tax, and $4,757 in CPP and EI premiums. So that means if you make $100,000, you will lose $26,000 in deductions, and you are left with $73,000. That means your average tax rate is 26%, but your marginal tax rate is 33%, meaning 26 divided by 100,000, that's 26%. But every dollar you earn above $100,000 will be taxed at this rate, the 33%. When it comes to your net pay, what that means is that you're roughly making $6,130 per month as your net pay. And for every $100 you make in your salary, you'll be taxed at $34, so you'll be left with $66. If we really break that down in terms of brackets, what that means is that at the federal level, anything below this bracket, the $53,000, you're only paying 15%. Anything above $53,000, at the next bracket, you're going to pay 20%. In this case, $100,000. The first $53,000 will be taxed at 15%, and the remainder will be taxed at 20%. Same thing applies at Ontario. The first $49,000 of your $100,000, you'll pay tax at 5%. At the next level, $100,000 minus $49,231, you're going to pay tax at 9%, and it only goes up from there. So in this example, The highest tax you're going to pay because you make $100,000 is 20% at the federal level, and you're in this bracket at Ontario, so the last $1,500 or so, you're going to pay tax at 11%. And the total, it works out to $26,000. So that in a nutshell is how tax rates and tax brackets work for personal income taxes. Now, it's a little bit different when it comes to corporate taxes. At the federal level, you're paying 15% flat in taxes. It doesn't really vary based on income levels. There's no tax brackets when it comes to corporate tax. Same thing at the provincial level. It's also flat. Each province will charge a certain percentage. Again, that rate will differ based on which province you operate out of. But generally speaking, there are no tax brackets like we saw for personal income taxes. It's not applicable for corporate income tax. Lesson 3, income tax filing. How does the income tax filing system work in Canada? And if you have to owe taxes, what are the options in terms of making payments? Let's talk through this. Essentially, at the end of the day, all Canadians must report their income to the CRA annually, and you do this by what's known as filing a tax return or a T1 return. And this is essentially a way for the CRA, the government, to know how much income you're making, what are the expenses, deductions, and tax credits that you are eligible for, and that determines how much is the net tax you either pay or you get back as a refund based on what's come off your paycheck. The deadline for filing taxes each year is generally April 30th. When I say generally, that means if April 30th falls on the weekend, you'll get an extra business day, so then it will be due May 1st or 2nd based on when April 30th is. Now, the other tax deadline that's applicable for self-employed individuals is June 15th. So if you are self-employed, you have a little bit more time and you are owing taxes. You still have to pay your taxes by April 30th, but you can file by June 15th. So no matter what, if you owe taxes, whether you are an individual or you are self-employed, you have to pay your taxes what you owe to the CRA by April 30th. And the way it generally works is that the tax system really, when it comes to tax filing, is based on the honor system. So it's really up to you to do a self-assessment. Yes, you'll get your tax slips, which we'll cover later in this course, what they mean, which will list your income. But really, what tax benefits you're eligible for, what tax credits, it's really up to you to make that self-assessment if you are doing your own taxes. Or the other option is to pay someone like an accountant that can do your taxes for you. But generally speaking, it's on the honor system. It's up to you to claim your income and your expenses and any tax deductions or credits you are entitled to. In order to file your taxes, you can use an online tax software, whether it's Wealthsimple Tax or TurboTax. There's many options out there, and they're all listed on the CRA website. And please make sure you use certified tax software, and that's why I emphasize, if you want to know which tax software to use, go to the CRA website and they will list what certified tax softwares you can use that are net file applicable. As I mentioned, you have to file your taxes by April 30th because if you don't, the CRA will impose heavy interest and penalties if you are late and you miss that deadline. And if you owe tax, what are your options? Well, you can pay by mail, you can pay in person, or you can pay it online. And I would generally recommend setting it up online. It's just quicker, easier, and your payment goes right to the CRA. And if you want to make your payment online, you can use the CRA's My Payment service. You can pay using your bank account, your credit card, debit card. There's many options available to you if you want to make your payment online. And if you prefer, for whatever reason, personal preference maybe, if you want to pay by mail, you can send a check or money order to the CRA. Just make sure you include your social insurance number and the tax year that you are paying your taxes for. I highly recommend going the online route because mail can get lost. There's more time that takes time for physical mail to actually get to CRA. So online is quicker, it's more secure, and it's just faster. And if you want to really pay in person, you can visit the CRA office and pay by cash, debit card, or a check. If you are unable to pay your taxes, you can contact the CRA and come up with a payment plan. They may still charge you interest and penalties, but it's better than having to deal with legal action by the CRA where they're coming after you for money that's owed to them. So if you are in that situation, highly recommend reaching out to the CRA. They will help you come up with a payment plan that makes sense, and that way you avoid any legal action by the CRA. Lesson 4, income tax benefits. What are some of the tax benefits you can receive? What are some of the non-refundable tax credits you can receive? And what are they in the first place? And what is a tax refund, and how do you get one of those? So depending on your income and eligibility, you are entitled to various benefits and refunds from the government. Tax benefits are essentially deductions that reduce the amount of income taxes you have to pay. Some examples of tax benefits include the Canada Child Benefit, the GST/HST tax credit, the Working Income Tax Benefit, and the Climate Action Incentives, just to name a few. Now, on the other hand, there are certain tax credits that are known as non-refundable tax credits. Now, what are they? Essentially, non-refundable tax credit is a credit that reduces the amount of income tax you owe. Some examples of non-refundable tax credits includes the basic personal amount, the home buyer's amount, the digital news subscription tax credit, and the tuition tax credit, just to name a few. Now, the way this differs from a tax benefit or refundable tax credit is that the total amount of your non-refundable tax credit, if it's greater than the amount of taxes you owe, you will not receive a refund for the difference. So, for example, if you owe $1,000 of taxes and you have, let's say, $1,200 worth of non-refundable tax credits, you will not get a refund for the $200 difference. Non-refundable, as the name suggests, it does not increase your refund. It can just reduce the amount of taxes you owe. Now, with that said, a tax refund, as the name suggests, it's essentially if you pay too much taxes, you get your money back from the government. It is not free money like people think that, hey, I got a tax refund, it's free money. No, it is essentially the money that you've given the government and they just give it back to you a year later because you're paying taxes every time you get your pay stub. There's a little bit of tax that's taken off every hour you work, and at the end, that tax goes straight to the government. Now, when you file your taxes in April, if you owe or if you've paid too much tax, you actually get your money back. It's like going to a store, you purchase an item, you're not happy with it, and you go to the store and they give you your money back. It's not free money, you're just getting your money back. So that's what a tax refund is. It is your money back for paying too much in taxes. In order to receive your tax refund, you actually have to file your taxes each and every year. As I mentioned in the last lesson, there are numerous options to file your taxes. There's different softwares available. There are different ways to reach out to the CRA. Just make sure you do yourself a favor and file your taxes on time prior to April 30th. That way, if you owe money to the government, you can make that payment. And if the government owes you, you can get your money back because they've held it for way too long, in my opinion. Lesson 5, Canada's income tax reduction strategies. And this is one of my favorite things to talk about. How can you optimize the amount of taxes you pay? Meaning, you only want to pay your fair share, and if there's ways to reduce taxes legally and that what the tax code allows, there are things you can do to take advantage of. Let's talk through those elements. So one thing you can do is change income sources. Now, this may not be as applicable when you are just starting a career, you got that first job and you're earning employment income, but as you progress through your career, you make more money, you start investing your dollars. There are ways to change income sources so you're only paying tax on an income source that's taxed more favorably, because not everything is taxed equitably. Income from employment, income from interest, they are taxed at the highest rates. Income from capital gains or eligible dividends, they are taxed at lower rates. So that's what I mean by changing income sources. If you can make more money from eligible dividends, if you can make more money from capital gains, you will reduce the amount of taxes you pay overall. And I'll give you an example to talk through that. So going back to my handy tax calculator, as we saw earlier, that if you make $100,000 in employment income, you are paying $26,000 in taxes. Now watch what happens if we change that source from employment income to eligible dividends. Look at that. You're paying less than $5,000 in taxes. So really, 95% of the income that you generate from eligible dividends goes into your pocket versus only the $73,000 we saw before. Now, what happens instead of eligible dividends? You have that same $100,000 from capital gains. Look at that. You're paying less than $8,000 of taxes. So you can see that between capital gains, eligible dividends, you're paying much less tax, even though you're making the same amount of income than employment income. And let's say if you have $50,000 from capital gains and $50,000 from eligible dividends, well, you are still paying less tax. You're not paying only $4,500 in taxes. So that's what I mean by if you can change your income source, you're going to pay less tax, even though you're making the same amount of money. And that's why it may be hard earlier on in your career when you're just starting out. You got that first job, you're just starting out your investing career, when you make more money, you want to figure out how can you better invest your money to optimize taxes. The other piece you can do is, and this is applicable when you are even starting out early in your career, is defer taxes. And what that means is essentially instead of paying taxes now, there are actually ways to pay taxes later on. One of the strategies involves investing in an RRSP or a TFSA, and they both allow you to defer or avoid taxes on your savings. So for example, with an RRSP, it reduces your taxable income in the year you contribute, and you only pay tax on RRSP dollars when you withdraw that money. So you might be contributing early in your career, and when you reach retirement, when you withdraw the money from your RRSP, that's when you pay your taxes, and you get the benefit of a higher tax refund in the years you contribute. A TFSA lets you earn tax-free income from any type of investment, and you can withdraw your money from a TFSA without having to pay any tax at all. As the name says, it is a tax-free savings account. Any income you earn within that tax-free savings account is tax-free, and you can withdraw your money tax-free. Alternatively, and this is a bit of a more complex strategy, is that you can leave your money inside a corporation or an investment property, which lets you defer taxes until you withdraw or sell them. Corporations pay lower taxes than individuals on active business income, and investment properties can generate rental income, and that is taxed at a lower rate than regular income because you can claim certain expenses against that income source. The last piece is maximize your deductions, and I highly recommend this because why pay more taxes than you have to? So make sure you take advantage of all the deductions available to you. And some expenses that you can claim are charitable donations, medical expenses, union dues, childcare expenses, and the list goes on. So definitely do take advantage of all those deductions because they reduce your income tax bill, plain and simple. For example, charitable donations can give you a non-refundable tax credit of up to 29% of the amount you donated at the federal level. Plus, there's additional tax credits available at the provincial level. So this to me is a win-win situation. One, your money goes to a charity in need, and two, it helps lower your tax bill. And if you've paid out of pocket for medical expenses, make sure you claim those on your taxes as well. And for everything you're claiming, this is an important step because people miss out on this. You need to keep track of all your income and expenses throughout the year so you can easily claim all the deductions you are eligible for as well as the tax credit. So essentially you want to keep track of all those receipts so you can claim them on your taxes when you file. And that concludes the first module. We've talked about how Canada's income tax developed over the course of the last 100 years or so, where it was put in for World War I efforts, and to today's complex tax environment based on how you earn income, you are taxed differently. Based on where you live, you'll be taxed differently. Based on different income groups, you'll be taxed differently. We've talked about how you can file your taxes online, by mail, or in person. We've talked about if you don't file your taxes by April 3rd and you owe taxes to the government, you'll be hit with interest and or penalties. We've talked about how different tax brackets work and how different dollars are taxed differently at different tax rates. We've talked about tax benefits and refunds, how you can take advantage of various tax benefits, non-refundable tax credits, and how you can essentially get a larger tax refund by taking advantage of the deductions available to you. We've talked about how to change your income sources so you can pay a lower tax. For example, $100,000 of employment income is taxed differently than $100,000 of eligible dividends. You can defer taxes by using an RRSP or a TFSA, and make sure you keep track of everything in terms of your income sources and receipts so you can claim your fair share of deductions when you file your taxes.